No matter how many times your teacher has tried to explain income elasticity of demand, or how many times you've searched this on Google, it's still not clicking for you. Well, you're in the right place. In this video, we're going to explore what income elasticity of demand is, including how to calculate it. We'll also dive into the main categories of income elastic and income inelastic, plus we'll explain what it means when a product has a negative income elasticity of demand value. Let's start off by understanding what do we mean by income elasticity of demand. Now, income elasticity of demand is a way to measure how changes in people's income affect the demand for goods and services. Think of it this way. Take the two key words out of the name, we are left with income and demand. Now, what we're looking to explore is how a change in consumer income influences demand for a product or service. Now, it's important to note that unlike price elasticity of demand, the values for income elasticity of demand can be both positive and negative. We'll delve into this more later in the video. Now, income elasticity of demand is incredibly useful for businesses. It allows them to make predictions about economic activities and plan their sales forecasts accordingly. For instance, during a recession, many people lose their job, leading to a decrease in disposable income, which raises the important question for a lot of businesses. How does this affect our demand for our products and services? Also, when a business is considering expansion into new markets, understanding the rate of income changes can offer valuable insights into whether a market is likely to be attractive for that business. But before we take a look at the formula of income elasticity of demand, let's first of all make sure we know how to calculate percentage change, as it's crucial for understanding income elasticity of demand. First of all, do you enjoy memorizing the formula for percentage change? No, of course you don't. Well, your dislike for this formula is about to become quite handy, because remembering the formula is very straightforward. It's a new value minus the old value divided by the old value times by 100. Now, onto the formula for income elasticity of demand. We calculate this by taking the percentage change in quantity demanded divided by the percentage change in income. Now, this formula is more or less identical to price elasticity of demand, with the only difference being we divide it by percentage change in income, not the percentage change in price. If you haven't already, I highly recommend watching our video on price elasticity of demand, where we look at a method that will make sure you never forget the formula ever again. Let's see an example of the formula in action. Suppose consumer income rises by 10%, leading to a 20% income in demand for our product. Now, in the case we take 20% and divide that by 10%, resulting in an income elasticity demand value of positive 2. But what exactly does this value tell us? Now, when categorizing income elasticity of demand, we have two main categories, income elastic and income inelastic. Now, on this we mark 3 points, -1, 0 and 1. For values to be considered inelastic, they must fall in between -1 and 1. This means they are greater than -1 but less than 1. Now, elastic values, on the other hand, are either less than -1 or greater than 1. Now, if a value is exactly 0, it is considered to be perfectly inelastic. If it's exactly -1 or 1, we call this unit elastic. And if it's infinite, this indicates perfect elasticity. So, when a product or service is income elastic, a change in consumer income leads to a larger change in demand for that good. For instance, if consumers' income increases by 10%, demand could rise by 20%, which gives us an income elasticity of demand value of positive 2. Now, most goods that are income elastic are considered luxury items, such as luxury holidays, supercars, high-end watches, and so on. Let's think about it like this. If you won the lottery, what would you be more inclined to spend your money on? Gallons of milk, or perhaps a Louis Vuitton bag? Unless you're planning to have a milk party, and if you are, and that is a thing, please no hate in the comments, you're likely to splurge more on a luxury item. However, we also have inelastic goods, where a change in consumer income leads to a smaller change in demand. For instance, imagine consumer income rises by 10%. For goods with income inelastic demand, the demand might only increase by 5%, which gives us an income elasticity of demand value of 0.5. Now, the majority of goods that are income inelastic are considered necessities. This is because regardless of whether your income increases or decreases, you still need these goods for daily life. Examples include your groceries, your rent, medicine and basic clothing. But earlier in this video, I mentioned that income elasticity of demand values can also be negative. When these values are negative, it identifies a negative relationship between the changes in income and demand. This means when consumer income rises, the demand for these goods decreases, and vice versa, when the consumer income falls, the demand for these goods increases. So for example, if consumer incomes rise by 10%, demand for a product could decrease by 5%, given an income elasticity of demand value of minus 0.5. Now, whenever we deal with a negative value in income elasticity of demand, we are dealing with an inferior good. Now, an inferior good refers to a product that is to be considered of lesser quality. To put it into perspective, think of a restaurant meal as a normal good, while an inferior good might be a supermarket-owned brand of noodles. Now, I'm not hating on supermarket-owned brands, but with an increase in income, you're more likely to go to the restaurant and pay for your food there. I hope this video has helped you understand income elasticity of demand, and feel free to check out more of our videos on our channel.